If somebody's currently sitting on quite a high rate mortgage, they maybe secured it a year and a half ago when the rates were really high, is it worth paying the early repayment charge to leave that and get on a lower deal?
Possibly. That depends on a number of factors.
Where'd you see the base rate?
I think you'll be four or south of 4 by the end of 2025.
Yeah.
How much do first-time buyers actually need as a deposit right now? You know, is it still realistic to look at 5%, or should they be looking at higher?
You can look at 5%. But what is really common nowadays is if gifted deposits from parents, and you're talking big deposits, and you're looking at like a purchase of $250 with £100,000 gifted deposit. It's really good.
Do income multiples still apply? I mean, or is it more about affordability
with some lenders, yeah. I mean, there's a couple of banks that are doing 5.5 times. Depends on your income.
Exceptional, but yes.
5.5 times.
What the main thing that brings that down the 5 times, even if you were on high income, would be children.
Use that as a TikTok quote. Children are expensive.
What is the most expensive mortgage that you guys have ever arranged?
Hello, welcome to the ESPC show again, and today, as ever, it's Paul and it's
Megan.
So it is. And this one, it's always one of our favourites, this one, isn't it? It's the mortgage one.
Yeah, we've got 2 of our ESPC Mortgage Advisors coming in to chat to us. It's David Lauder and Paul Demarco. You'll have seen them on the podcast before. We're chatting about a few different topics today.
We sort of asked the same questions, but we got some very different answers, and then we scratched the surface of a few things and got into swap rates, got into what's debt and what's credit. I just thought it was really interesting. £1 million mortgages as well.
Yeah,
about that.
Absolutely. So I guess without further ado, here is the episode.
Okay, we're back. We're going to talk about mortgages today. In fact, we've got a snappy title, haven't we, Megan? It is £1 million mortgages and what the rate cut means for you. So there you go.
Yeah, so I guess...
Two experts?
Yes, we do. We've got David and Paul from ESPC Mortgages joining us. We've had you guys on the show before, so we'll link all your previous episodes for people to go back and watch them. But today, I think the best place to start is with obviously the recent rate cut. The Bank of England cut the base rate just a couple of weeks ago from 4.75% to 4.5%. So I guess, what does the Bank of England base rate cut mean for homeowners right now?
For a lot of homeowners, not very much, because they're locked into their fixed rate deals, which means fixed rate means it's the same terms for a set period of time. For people that are coming to the end of their deals during the course of 2025, hopefully it will mean slightly better news for them, because they will get offered the rates that are reflective of the market at the moment. And for homeowners that are on tracker rate mortgages, which are basically the reason they're called tracker is because they track the Bank of England base rate. That means that their rate will have went down by 0.25%, because the Bank of England has went down by 0.25%. So it's good news for them. It's good news for people deals are coming up to an end this year, and it's also good news for people that are going to buy houses.
And when we say this year, I mean, as we know, the MPC, the people who decide the base rate, 7 more meetings this year. Lots of talk. We spoke before Christmas, didn't we, that we'd see the base rate potentially by the end of the year being sub 4%. We're already seeing sub 4% mortgages out there, aren't we? If you were in a fixed rate coming towards the end, what would you be doing? Just hanging off at the moment, or?
Well, what we do at ESPC is we typically say to clients, we contact them within the last 3 months of their deal, and we review their options. What some lenders do, which is a really good feature, is if you decide to stay with your existing mortgage lender, you can secure a deal 3 months in advance, but then if that rate goes down with that lender up until before you start the new deal, they will give you the lower rate.
Okay.
So what that basically means is it's like the rate you choose becomes a safety net.
Yeah, that's good.
And that's only with a lender that you stay, and not all lenders offer that. But that's a great feature, because if you take it 3 months before, Paul, and then in month 2, month 1, the rates go down, then they can potentially get the benefit of that.
Like that.
Paul, how quickly do lenders actually kind of implement this? How quickly does it affect the products?
Yeah, the fixed rates we're referring to really here, and the trackers, Not immediately. I've noticed the cut was it last week or the week before? I think it was last Thursday, yeah. So I've noticed a couple of lenders are now starting to cut their rates already. Usually within about 2 weeks, usually most of the lenders have done what they need to do with the fixed rates and the trackers and dropped them. But the trackers would go down anyway automatically, but the fixed rates usually take a couple of weeks to actually take effect for any kind of sort of reductions on average. Yeah.
And we've mentioned rate cuts a few times there. What do you think, end of the year? I mean, I think we've gone on record saying, well, I have.
Yeah.
I think it'd be sub 4%, probably 3.75. What do you guys think? Where do you see the base rate?
My own view is I see the base rate probably this time next year, probably around about sort of 4%. I think there'll be a couple of cuts at least, maybe 3. Obviously it depends on economic factors and inflation, etc., but I do believe we're in a good position. It does depend as well, obviously, what happens in the global world with Mr. Trump, etc. But I'm still pretty confident that we'll get some cuts.
Spoken like a chancellor.
I think you'll be 4 or south of 4 by the end of 2025.
Yeah, it sort of feels that way, doesn't it?
I think May, June time you might see another reduction.
Yeah. And they talk about these swap rates, don't they? And
swap rates are not what the consumer knows about.
Yes.
But the swap rates are the golden rate for mortgages, not the base rate. Swap rates, what they buy and sell money for, etc.
And it's normally a forward indicator, isn't it, of kind of where people think things might be heading.
And what you find with the swap rates is the Bank of England base rate changed last Thursday, but the lenders were sort of already ahead of the curve.
Yeah.
And that was because of the swap rates.
Yeah, absolutely.
And sorry, just in case anyone doesn't know,
what are the where you see the swap rates?
what are swap rates?
Swap rates, well, Paul, I'll let you help me here, but I think it's sort of how they buy and sell money.
Yeah.
Right, okay.
And,
in the old days, they used to lend what they got in, but now they go to the money markets, get the money at A, and then loan it out at B.
That's basically it in a nutshell. Yeah, and as David says, that's an indicator on how the fixed rates are going to go. We can gauge these. We have a portal for that, don't we?
Yeah, we do. There's an app and a website that you can look at.
Okay.
Yeah. It tells you how to track them, and it'll show you. It's like shares. It'll
Yeah.
show you on a daily basis. Green going up, red going down.
Don't you have yours open every day?
Sorry, say it again.
You have yours open every day.
No, I don't. I don't. I'll be honest.
Some
right?
did. Yeah, some of you did. It was just on your screen.
It actually shows you 2 years, 3 years, 5 years, doesn't it? And 10 years as well.
Yeah, because the 5-year swap rate can change differently from the 2-year swap rate.
Yeah, and again, that's people almost forward predicting where they see it. The people in the markets, the money makers, kind of taking speculation on where they see it going. So, yes, it is a little tip. Yeah, Google swap rates, get yourself on there. It's good.
Yeah, the next question I was going to ask was if somebody's currently sitting on quite a high rate mortgage, they maybe secured it a year and a half ago when the rates were really high, is it worth paying the early repayment charge to leave that and get on a lower deal?
Possibly. That depends on a number of factors. What the interest rate was a year and a half ago compared to what it is now. But the main thing here is what's the penalty for coming out of that deal from 2 years ago. Now that penalty could be mitigated by, say you had, say, a 5-year fixed rate 2 years ago. I'd probably unlikely you done a 5-year fixed rate. So let's look at, say, I don't know, a 3-year fixed rate with a year left, okay? If the penalty is very small and the rates reduce quite substantially, you would calculate what the penalty is and how much you're going to pay on the old mortgage in comparison to the new mortgage and work out if it's worth moving.
Okay.
That's the best answer I can give you.
Yeah. I mean, but to add into that, given Paul's comment earlier about sub 4 rates, those sub 4 rates come at the moment with a £2,000 arrangement fee. So £1,999. So what I'm saying is you've got to then add that onto the penalty as well.
Yeah, it's not quite. I say it's not a yes no. It's
not as easy, and I'll be honest with you, I would say it's rare to justify the penalty.
But if you're sitting on a 7% fixed rate or something, it's probably a different conversation.
Yeah, that's different.
Just depends where you are in the cycle.
It depends where you are. It depends how long you've got to go, but it also depends what loan to value threshold you're in for the rates now. Because if you're in a higher band as opposed to lower band, the rate difference might only be 0.5% difference or something like that. So it's definitely not one size fits all.
Indeed.
Yeah, totally.
Okay.
And I guess the big question is, do you think that the current drop in the base rate, is this going to affect house prices at all? Is that going to affect the market in any way, do you think?
Well, we hope so. We're getting busier as we speak. I think the benefit at the moment for house buyers is, I know every mortgage I've done this year, the properties have gone, the purchase price has gone for home report value, which is nice to see a bit of stability.
So no
there.
real premium being paid, just a value.
Yeah, just the valuation. I think, will they affect house prices? I personally think a lot will be to do with the stock and how much houses are going to come up for sale, because the more we've got up for sale, the more you can spread the buyers. But if we've not got many up for sale, but we do have an audience of buyers, then that might increase the house prices because they're all going for the same houses.
I'd agree with that. I think that's
simply economics, isn't it? To be
supply and
honest,
demand.
supply and demand.
I think it's interesting though, isn't it? Because clearly as base rate drops and the cost of renting goes up, there is that sum, isn't it? We go, actually, we all better get them always if we can. And I know that's not for everybody. And if you can, maybe you would now, because as I say, affordability's got a little bit easier.
I agree.
I think that actually leads us on to what we were going to chat about next quite nicely, Paul. I think in terms of obviously those kind of first-time buyers, how much do first-time buyers actually need as a deposit right now? Is it still realistic to look at 5%, or should they be looking at higher?
You can look at 5%. I mean, I don't do many mortgages at 5%. I don't know why that is. It's maybe the audience that I attract, I don't know, but certainly 10 and 15% is more common.
Sure.
But what is really common nowadays is if gifted deposits from parents. I got a lot of this where they're giving like lots of money to their son and daughter, uncles and aunties, grandparents, and you're talking big deposits, and you're looking at like a purchase of $250 with £100,000 gifted deposit. It's really good.
Wow.
I'm not saying everyone does that, obviously, but
Nice to my grandma.
I think 5%, though, in answer to the question, is realistic. That's quite a common thing. There is an audience of mortgage lenders who'll do 5%.
That's good.
If you're in, your circumstances are quite straightforward, it's fine. The unhidden sort of thing we don't know about is the credit score. So the credit score is at its highest threshold for a 5% deposit because you're bringing the bare minimum to the table.
So they're going to scrutinise you a little bit harder.
They're going to scrutinise. You're going to have to have a good credit score.
Less
but
forgiving,
I've done 95% mortgages, and they, as far as I'm concerned, they're not a rarity. They're quite normal.
Can I just go a little bit further? There was that 100% mortgage, I think it was Skipton, that were offering that if you were in a rented property, evidence that you were paying. Is that still going? Have you done any of them?
No.
Because I thought that would have been quite popular, but
not done any.
It's not.
Not done
it's
one.
funny, Paul's right, actually. We haven't done any, and we've not had a lot of inquiries about it. And I actually did I don't know if it was a blog on it or a podcast where I spoke about it, and it's just, but they clearly are doing it. And there's a lot of common sense to it. You're getting to borrow the same that you've been paying in rent, so you've got a track record. I think the bit that's a little bit uneasy with it is that you must take a 5-year fixed rate, and that 5-year fixed rate, because you're not bringing a lot to the table, is quite high. But the flip side is, yes, they do it, and yes, they're still doing it.
And if you want to almost preserve your deposit and use it for something else, again, you've got to do the maths on these things.
Well, you can do it, Paul, to get the house, because you can use the deposit for the offer's over. Or for your LBTT. Correct.
Your tax.
I guess the negative would be the chance of negative equity if the worst case has happened and the value of the house dropped. But that's unlikely.
No, that's a good point, Megan. I
unlikely.
suppose where it's slightly a moot point here is because we're in Edinburgh. In the UK, they do it for the whole UK, so it's a good point for that.
Okay. Shall we do the biggest question? This is a great question.
You go ahead.
You ask it, go on.
Okay.
I like this.
So what's probably like the average threshold for a mortgage?
I suppose the question is, do income multiples still apply? I mean, or is it more about affordability now?
Some lenders, I mean, there's a couple of banks that are doing 5.5 times. Depends on your income.
Exceptional, but yes.
5.5 times.
I mean, can I mention the bank that does it?
Over £100,000.
Atom Bank do it.
Atom Bank
do it.
Challenges,
Nationwide have got something similar. So it depends on your income and credit score, but you can get like a lot.
5.5.
I mean, if you're looking at £1 million mortgage, obviously you would need to be earning a couple of $100,000, obviously.
Yes.
And that's not uncommon nowadays. Depending on obviously what you do, and you've got a partner, like all you need is really say a surgeon and like an accountant or something like that, earns 200,000. Then that's possible.
Yeah.
I mean, the normal multiples are about 4 to 4.5 times.
Yes, that's
Okay.
it.
There isn't a set multiples because it depends how much commitments you've got in the background.
Yeah.
So like, you know, some you can have two clients on exactly the same amount of money, but one's married with kids, and got credit cards, one's single with no kids, they can get more money.
Yeah.
Okay.
So, but 4 to 4.5, but Paul's absolutely right. There is lenders with particularly high net worth clients that can go easily in excess of 5 times income.
Wow.
Yeah. What the main thing that brings that down the 5 times, even if you were on high income, would be children, because children are expensive, and also childcare is up until 3. You've got to pay quite a lot of childcare if you want to work full time. And I've got people that are paying like £1,200-1,300 a month on childcare. It's just ridiculous, but that's what they pay, and that's taken into consideration when you're doing your calculations, and that can bring it right down again. You know, it's like a loan, really. You know.
We use that as a TikTok quote. Children are expensive.
Well, they are. They are. Tell me about it. I know they are. David in here could tell you that right now. Honestly, even if the ones I've got at my age are expensive, but we won't go there with that.
Dave's got a rise.
We will not go there.
Especially if they need £100,000 deposit.
Yeah, exactly.
Yeah.
But you'd be shocked at the amount of people that will give their children that just to get on the ladder.
People kind of love to hear about, really expensive properties, who lives in them, that kind of thing. What is the most expensive mortgage that you guys have ever arranged?
I've done a couple. I've done one at just under $1 million. It was 999,999. There was a reason for that. You had to keep it under $1 million. I can't remember the reason, but I had to keep it under $1 million. But the guy did earn £1 million a year.
Wow.
Okay. Yes, he was well, I can't say what it was, but I better shut up. But
He was a
but
mortgage advisor, was he?
He was not. No, he certainly was not. And I've done a couple at $750 for a couple of fund managers.
Yeah.
Obviously, no names, no pack drill, but but yeah, $750, a couple, one at $1 million. But they're pretty rare, to be honest with you, in Edinburgh. You don't get many like that, to be fair.
Yeah, but you get some. I suppose it's that thing, isn't it? If you're cash rich, but you think, actually, I can make more by keeping my money back and investing it versus a mortgage at wherever the interest rate is, you're probably doing your own balancing, aren't you?
Yeah, some of them aren't actually any more cash rich than somebody that's buying at 500,000.
Okay, yeah.
Some of them still only have, I don't mean only, but they've only got £200,000 deposit or something like that. Yeah. But they've got big incomes.
Yes.
Because I'm the same as Paul. I would say my numbers are roughly the same. I'd say I think I've done one at $1 million and a couple at late hundreds. And you've got to have a certain deposit when you're borrowing that amount, certain percentage. Sometimes the lenders want you to have at least like a 15% deposit because of the numbers.
It's the risk factor again.
But what you find is sometimes they do have big equity, but sometimes they don't have any bigger than anybody else. It's just that they want to buy a bigger and better house.
And is it just a routine lender? Do you go somewhere special?
You don't go, when I say you go anywhere special, what can sometimes happen subject to sometimes it's just business as normal. Yeah. And other times you go to the lender's premier banking.
Right.
And what that basically means is that you're given a designated person who will be looking at it and who may actually be communicating with us as brokers directly on what they need. And you're basically getting a more hands-on approach.
Yeah, it's either called Premier or large loans, basically. Yeah.
And so something that we always like to ask as well is, do you have any weird or wonderful stories of any clients or applications that you've been through? Unique circumstances, maybe a better way to put it.
First, or you go first?
I'll actually.
Okay.
This is not a funny story, but funny sort of as in strangers. You're talking about 95% mortgages. So yesterday, I submitted a 95% mortgage. They had no money of their own. It was a gift from their parents, and the case was offered today.
Wow. So that's a mortgage offer within not even 24 hours?
One day.
Wow.
And that's a 95% mortgage. It's common, as in cases can happen like that sometimes, but this was a 95% mortgage with no money coming, like no money self-generated by the clients.
Why was it through so quickly then?
So I think the lenders have got their own intel systems that, like, obviously get to do a lot of what they need to do. They had a very well packaged case.
Sure.
Obviously, must have had a good advisor, and basically we gave them everything straight away, and maybe also a sign at the moment that the mortgage lender is slightly quieter.
Yeah, and it can happen. But as you say, you know the drill. You know what they're going to be looking for, don't you? They haven't done it all these years.
Yeah.
Yeah. Okay.
This is not a funny story. This is actually.
We want funny stories.
It's a nice story.
Okay.
It's a nice, but it's a bit long-winded. But I'll cut it down. Okay.
We've got an hour.
I did the mortgage for a couple, and then about a year and a half later, I tried to do a mortgage for her twin. Okay, single girl and her own school teacher. And everything looked great on paper and all that. She never had a clue that she had a problem with her debt. Okay, and what the problem was, it was basically is that the credit agencies, when you look at like ClearScore or Credit Karma, whatever, TransUnion, Equifax, and Experian, all got her mixed up with her sister. Okay, so what they were doing, because they were born on the same day, okay, and they had obviously the same surnames, because the one who was married didn't change her name, and they lived together. She lived in the same house, and they had the same initial. Okay, the credit agencies got confused and thought that her sister's debt, which was a mortgage and some credit cards, were hers, but they weren't. So of course, you try and get that changed through credit agencies, it is a nightmare. So she eventually convinced the credit agencies to change it, but it takes months until they bought the house, you see. So what I had to do was I had to convince 2 or 3 lenders to change it. Nobody would do it, but eventually, because I'm a dog with a bone, I can't mention the lender's name because that wouldn't be fair. Eventually, through time, we spoke to the senior underwriter, and he took a pragmatic view and realised it was a mistake and it wasn't her credit, it was her sister's, etc., etc. And eventually they approved the mortgage. She was absolutely delighted about it.
Wow.
And still to this day, I don't think that's been sorted out, because I asked her about a month ago, how are you getting on and all that, blah, 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 because she was going to take another insurance out, but she decided not to. She said, it's not cleared off my credit yet, it's still on there. So there you go. That was a good story. At least she got a mortgage out of it.
It's nice, as you say, that somebody can be pragmatic in this day of criteria and everything else and AI. It's nice that there's somebody who can make a human decision there.
Yeah.
Because as you say, it's a perfectly clean case, isn't it? But
I had to get the business development manager involved, then his boss, and then the senior underwriter decided.
Did they want to see it?
Say that again, sorry?
Did they want to see the 2 sisters in the same room?
No, they don't want to see anybody. No.
Okay.
Anyway, so there you go.
Brilliant. Like that. Thank
Got
you.
to watch that with twins.
That's a good lesson, I think.
Yeah. Shall we do the quick fire stuff?
Yeah, absolutely. So, Paul, do you want to kick us off?
Okay. So, quick fire round. Quick answers. Paul. What was the absolute minimum salary to get a mortgage in Scotland? So, what would be the...
There isn't a minimum salary.
There isn't. So it's again just the affordability stretch.
It is. The only thing I will say, sorry for not quick fire here, is that the multiples we've spoke about previously on this podcast don't get generated with minimum salaries because the cost of living, council tax, gas, electricity, food doesn't. They're not able to dilute that money. So the multiples will dwarf.
Yeah, okay.
Someone on 10 grand a year that has a credit card debt and maybe pays rent, and they'll not get anything. They just won't get a mortgage.
Yeah. But if it's in the 20s...
Yeah, in the 20s,
is fine. You'd like to think they'd get close to 20, up to 80.
Yeah.
But that's like, what I'm saying is it's harder to get through the multiples on the smaller incomes.
Yeah, absolutely. I remember when I was on a youth training scheme, I was on £25 a week and I tried to get a mortgage.
Did you? Really?
No. I was only 17.
Right.
What's the age you can get a mortgage as well?
18.
There you go. So it was all against me, you know. Still look at that house.
Good enthusiasm.
Honestly, I was so desperate to get on the ladder. But anyway, okay. Would you get a tracker or a fixed rate mortgage right now?
Will
you both agree on this?
We will.
There's no right answer. That depends on their circumstances, their attitude towards risk, their ability and their budget to be able to handle payments going up or down, and what there's like how long they intend to live in the house, etc. So that's more where I'd like to think we come into our own and give specific advice.
Yeah.
Right. I'll just want to add to that. Trackers are higher on the interest rate just now than fixed. Now, you've got to gauge this. Now, if we say what we thought earlier, that the rate will drop from 4.75 to say 4 or 3.75, it could be worth taking a tracker, but it depends what the difference just now between the tracker and the best fixed rate is. If there's not a lot of difference, it might be taking a risk of might be worth taking the risk of taking a tracker. If not, I'd probably go for a fixed rate.
Got you.
I don't think the quickfire nature of these questions is working out, but that's okay.
It's good.
So the final one we've got for you guys is, what's the biggest mistake people make when applying for a mortgage? Usually.
I mean, I think one of the biggest mistakes, which is a bit ironic, is some people forget about all the debt commitments they've got. And what can happen is that when you apply for the agreement in principle, the amount that gets offered doesn't correlate with what you've done your research on. And what that means is because there's undisclosed credit on the credit score, so you have to then go and find out more about it to get it to cross-reference to then allow them to get an accurate decision. So that's quite, you wouldn't think that, but people forget about some of the debt they've got.
They do, and a good example of that is a lot of them forget about things like if you go and get an Apple phone from Apple and you take out a loan, they don't think that's debt. They don't realise that's a credit commitment. Another one is buying a sofa from one of that's another one. These are all debts. And even things like Klarna as well, because you pay up 3 months, although it's not really a debt as such, but it kind of the lender will look at this.
I mean, even things like football season tickets.
Really?
Well,
because
if you buy a season ticket and credit for
And I've got another one for you, which I've only found out last year, and it doesn't happen with all, and it's very small usually, but some buildings and contents providers, if you want to pay your contents and buildings, not buildings, sorry, contents. This is obviously rent, and you take that out. It's very small, but that can be on credit as well.
That's right, because you just span it over 12 months and you don't think anything of it. But it's
unbelievable, isn't it? That's what contents usually in buildings is on.
Tell you what, we're learning a lot on this episode. These questions are getting us more good stuff out there.
Yeah, absolutely.
So we keep going.
I think
we've arrived.
I think this is our final question was, what would be your one piece of advice that you'd give to a buyer right now?
Well, the bit of advice I give to a buyer right now is to make sure your credit file is up to date for a start. To make
when
sure
you say that, what does that actually mean?
Go on and check Clear Score or Credit Karma.
So sign up and just
sign up. These are free. Like Credit Karma's free. I use Credit Karma myself to make sure that you've nothing on there that should be on there that's not yours, kind of thing. Or, I didn't realise that. I didn't realise I've been chased by council tax 3 years ago, and I've got a default against me. How is that? That kind of thing. It's unlikely. You probably know about that. But anyway, just check that. Also, I mean, this sounds really crazy, and a lot of folk don't agree with this, but I think it's a good thing to do, is to, if you don't have a credit card, take one out, okay? But what you do is you spend on it, very small amounts, and you pay it off right away at the end of the month, so you don't accrue any.
So you're establishing a history of
the only
credit history.
Paul's absolutely 100% right. The only thing I will say is, if you're going to buy in the next 3 months, then there's no point.
In doing it. This is long term.
Okay.
And also make sure that you don't exceed your overdraft on your bank statement. I don't think many people do that anyway, because you get heavily charged. But these are the three main things. And obviously the thing is, as well, is try and get yourself a deposit of at least 5%. But also take into consideration, you've got to pay solicitors' fees, possibly Scottish stamp duty as well, and maybe other fees as well. So take all that into consideration. It's not just a deposit.
And be nice to your grandparents.
Yeah, be nice to your grandparents, your mum and dad get a windfall. There you go. You know. So
I think the advice I would give is, if you're paying rent at the moment and you have the deposit and you have your credit score, is, I would say, the best advice is, I'd say, buy a house. We are mortgages are readily available. We're in an interest rate time now where rates are getting better, but even at the rates at the moment, they're perfectly normal. They're not high. These are normal times, and all you're doing is your standing order to your rent is going in a different direction, which is to your mortgage. which is towards your future
Yeah.
as opposed to your landlord's future.
Yeah, absolutely. And I think, I mean, you've said it before on the show, don't write yourself off. Don't assume you can't get a mortgage.
Mm-hmm. Yeah,
Just-
never do
I
that.
mean,
Yeah.
it's free to find out from you guys, isn't
Exactly.
it? You know,
It's a psychological thing, Paul.
Yeah,
Sometimes, and it's not as bad as what you think.
it's like
it
going
is.
to doctors, you feel better afterwards.
That's right.
No, you do.
You never know,
definitely,
do you? You know, and I think that's it. You don't write yourself off, go and find out. Because as you say, if you have to repair your credit history, at least you're starting down that road, aren't you?
Yeah, definitely.
Okay, so if there's anyone out there that's like what they've heard today and want to know more, how did they get hold of you two?
Just either call in on 0131 624 8680. That's the ESPC Mortgages phone line.
You've memorised that, haven't you?
Or go online and look at the mortgage tab on ESPC.com and you'll find all the contact details there.
Yeah. I think there's even photos of you two.
There is,
Yeah.
I know.
Yeah.
Aye, all the mug shots, yeah.
Good stuff.
Oh, thanks very much, guys, for coming.
No,
on.
thank
you.
Yeah, we really
appreciate
appreciate
it.
it.
Really enjoyed
I tell you what, I enjoyed that.
Yeah, it was really
It
good.
was different, wasn't it?
Yeah, really good. And if you enjoyed it, please feel free to leave us a review wherever you're listening or watching. And also get in touch with your questions. If there was something we covered today that you want to find out more about, or if you've got any other property related questions, please send us an email at marketing@espc.com.
Definitely, I definitely learnt a bit there though. I mean,
yeah.
certainly that bit about, you know, you take out your insurance over 12 months and you suddenly realise that you've got a debt against you.
Yeah, you would never
A few
think.
things,
Yeah, I would never have thought that. So
No, and I think that about going in, looking at your credit history, talking to your advisor was really good advice.
yeah.
So yeah, a little gem of a show, I think. Oh, yeah, good
Yeah,
one.
Absolutely. So we'll be back again in a fortnight's time with a brand new episode.
We will. We will see you then. Take care. Bye-bye.
Bye. The information contained in this podcast is provided in good faith. Whilst every care has been taken in the preparation of the information, no responsibility is accepted for any errors which, despite our precautions, it may contain. The initial consultation with an advisor is free and without obligation. Your home may be repossessed if you do not keep up repayments on a mortgage or other loans secured against it. ESPC UK Limited is an appointed representative of Lincombe Consultants Limited, which is authorised and regulated by the Financial Conduct Authority.